Hello and welcome to the second episode of The 12. As you might know if you joined us last time, the aim of our game is to try and help you allocate your reading time better in 2021, which basically just means we're going to try and help you decide which books are worth buying and which books are worth your time. When I was preparing for this interview, looking through my Kindle, I discovered a whole bunch of books which I wish I'd never really spent my time on. I wish I'd spent time on other books instead. And that really highlighted the whole point of this podcast series, where we're going to interview one author every month about a book that we think you should bother reading. And that's based on the editorial team's feedback, the books we've been reading, the books we liked and didn't like, and so on. This month, we're interviewing John Butler, who's written a book called The Golden Revolution Revisited, How to Prepare for the Remonetization of Gold. It's all about a return to the gold standard, which might sound archaic or old-fashioned, but it's actually part of what John calls the cycle of history, the monetary cycle of history. And he talks about why you should expect a return to the gold standard, what it would mean, what the investment implications are, how it might play out, what sort of role Bitcoin and cryptocurrencies could play and fintech could play, all of the different risks and opportunities of return to the gold standard. And I think he pretty much says why one is inevitable, which is particularly interesting. I love the book. I learned a whole bunch that I didn't expect to, despite being interested in the area. And John, let's go over to you. I'm told you've actually got a copy of the book, which I don't. I've only got the Kindle. So would you please show us what the book actually looks like?
There it is.
There it is for everyone. So you can buy it on Kindle as I did, which is why I'm not the one showing it to you. It's a bit less dramatic for me to show you the Kindle. But before we get into the contents of the book, I wanted to declare what is probably not quite a conflict of interest, but it's worth mentioning that you do work with us. You're on the Hard Money Council of Gold Stock Fortunes, which is the Gold Stock newsletter that we publish. So while we have no financial interest in the book itself, I thought we should mention that one. And with that out of the way, let's kick off and dig straight into the argument. What I thought I'd do in these podcasts is overstate the argument that the author of the book is making to try and highlight to the readers what's really going on. So if I had to sum up your central claim and exaggerate it a little bit, it's that the gold standard is going to make a comeback quite soon. It's pretty much inevitable. And that there's going to be all sorts of consequences of this that people are not really prepared for, and that they should start thinking about and should start preparing for, so that when it does happen, they're ready for it and they're ready to profit from it. Is that a fair summary?
I think that is fair. And to be honest, it's not overstating the case too strongly. I think the big question here is timing rather than what's going to happen. So I think it's a very good characterization of the core topics of my book.
There's a whole bunch of other stuff that you go into as well, like the role of cryptocurrencies and fintech and how this revolution unfolds. And what it really means for the reader. But let's start at the beginning, which is really a prediction that the current monetary order is not sustainable, and therefore it is likely to fall apart. And that when these things fall apart, historically speaking, it is gold that the world moves to. So tell us about just how solid that argument is, because when I read this book, that's what I really got from it. I'm a committed gold bug. I love all of this sort of arguments. I thought I knew everything there was to know, but I certainly didn't. And having read your book, I know a lot more. And yet the argument behind it all is quite familiar, really.
Yes. Well, look, the reason why I wrote the book was because when the financial crisis of 2008 hit, I had already had nearly a 20-year career working for major investment banks. And yet my academic background is in economic history. And so I felt that not only could I kind of see what was unfolding in real time, I also felt I could place it in a historical context. Every financial crisis is unique in certain respects, but to be fair, if you look through economic history, you can find parallels. You can find certain sort of indications that some things are simply naturally cyclical. They come and they go, and that there's not simply this linear progression from one point in economic history to another. There are lots of ups and downs, lots of cycles, and so on. And so when I looked at 2008 specifically, what was happening was a very large global financial crisis with the foundation being a completely unbacked fiat currency regime. That is, with the dollar at the center, of course. Now, we'd had periodic crises ever since the US went off the gold standard in 1971. But they weren't as universally global as 2008. There was something new and different about this one. And really, what was happening in the aftermath of that crisis was the US, in unprecedented fashion, simply trying to print its way out effectively of the crisis and assist other central banks who hold dollar reserves as their own de facto monetary base, help them print their way out of the crisis. And so if you take a look at where that was leading, the fact is that that doesn't solve the problem. It doesn't solve the fact the world is on a fundamentally unstable monetary foundation. It simply buys time. But it buys time in a way that favors the issuer of the global reserve, in this case, the United States, over other countries who hold those reserves. And that is where I believe we see gold eventually reemerging as the reserve once again. Because game theory is really instructive here. And this is what my book does that I feel a lot of other books don't do, that also talk about a currency reset, the unstable global monetary equilibrium, and so on. Game theory instructs that when you have multiple players in a game, the only true stable equilibrium is that which is the best response to other players' interests. That is, you can't just favor your own interests at the expense of everyone else. And that's where we're at now. The US can print money all day long to bail itself out. It can print money all day long to bail out other countries, should it choose to do so. But some countries export more than they import. Some countries are more economically competitive than others. They're the ones that lose each and every time the US and other net importing countries simply print reserves out of nothing to bail themselves out. And so the only solution to this situation of huge imbalances between exporters and importers, and the ability, the exorbitant privilege, call it if you will, for the United States, the only equilibrium is for that exorbitant privilege to be taken away, to re-level the playing field monetarily, and for the big exporting countries, Germany, Japan, China, and a handful of others, including oil producers, to no longer be on sort of the losing side of this game where every time there's a crisis, the US and other big importers just bail themselves out.
I think that's a summary of the book as a whole. So when you, in your introduction, say that there's the 4 sections, I'm going to read them as you've written about them in the actual book. Section 1 examines the problems with the current system, the fiat money system. Secondly, you explore why there's going to be a return to the gold standard specifically. Section 3 is all about this transition period, and you mentioned whose interest it is to go back to gold, and it's those exporters, especially the resource exporters. And section 4 is all about fintech and where the blockchain and all these sorts of things can play a role. And then there is a 5th section, which you don't mention, which is all about the social impact, I suppose, of going back to a gold standard. But I think the first one that I want to explore out of that is actually one that Steve Baker, the MP who wrote your foreword, mentioned. And it's the idea of we've exhausted the current system, or we're close to exhausting it at least. And quantitative easing is the giveaway that we're at the point where all this is getting a bit ridiculous. And the desire to move to something more stable is getting closer and closer and closer over time. And I think Steve Baker writes, sooner or later, this system will blow up, taking with it deficit spending and other promises, which simply cannot be kept. Our economy and politics will become healthier for being more honest. The rebuilding will begin. But there's this transition period, which is going to be very difficult first. So can you explain why quantitative easing is such a giveaway that we've reached the end of the tether of the current system?
Well, quantitative easing is a way for monetary policy to get around the natural constraint of interest rates not being able to fall sustainably below zero. It's a basic concept of, well, and this goes beyond just humanity. It's a basic concept universally in the physical world that systems tend toward disorder. This is the second law of thermodynamics, if you will, entropy. And The fact is that when it comes to the human condition within that, other factors equal. If you don't work, if you don't uh, try to maintain your home, if you don't try and keep things from falling apart, the fact is that whatever you've created up to that point, whatever value you've created, wealth you've created, it is going to trickle away or eventually just collapse. You know, you have to maintain your house. You have to generate something to eat for food, get, you know, cloth for clothing, whatever it is. And what that means is that there is always this need to save, even if in principle what we do day to day is consume. But if you consume 100%, you're not going to survive longer term. You're going to consume your own capital base. Your home's going to fall apart and so on. Okay. What that means is that it is only natural that interest rates, that is the price of money today, as opposed to the price of money tomorrow, interest rates must naturally be positive. And if you look at the history of interest rates throughout the centuries, and we do have, you know, reasonable data on this, interest issuing governments, that is the so-called parlance, representing the pure time value of money rather than some inherent default risk, those have tended from, you know, anywhere from sort of 2 to 5 or maybe 6% throughout the centuries. And anything below that has been very temporary, and anything below zero has actually really never been observed in history before. And so there's this natural tendency for interest rates of easing as a way to try to get around that, and by stimulating the economy very, very artificially to get it going again. And so Steve Baker's absolutely right to call it for what it is. It is very artificial, very unnatural, and necessarily a temporary emergency measure that distorts the economic capital structure, provides disincentives to save, implies that we're consuming our capital base rather than building it and improving it. And that is just not sustainable, right? There's a famous analogy here that if your home cold and you run out of firewood because you didn't work and save enough firewood for that winter, well, but what happens then when you've burned the furniture? What are you going to, the floorboards? What's it going to be? That's capital consumption. That is why rates of economic growth have been so in recent years, and there's no way out of that without fixing the money itself.
One of the messages that I took from the book, which I really believed in already, but you explained it particularly well, was the idea that money is supposed to be money, but in our modern monetary system, money is one of the policy tools, one of the levers that, in this case, central bankers and governments as well, can push and pull on to try and get what they want. And that's where it tends to go wrong. So the analogy you use, which I thought was the particularly brilliant part of the book, is actually from Friedrich Hayek, that it's similar to sports. It's like a sporting game where in a football match or any exciting competitive sports, if the rules are unclear, everyone just keeps arguing with the referee or trying to buy them off or whatever it is. And if the rules keep changing, then you get rent-seeking behavior, which is appealing to the referee, diving, all this sort of nonsense. And so if you've got a monetary system where the money supply and interest rates and all these things can constantly change, that's like having a referee who's easy to manipulate, to control, and that completely changes the game in a way that's not good for the economy. And what we've got is the long-term consequences of that game being played badly bearing down on us over time now. And obviously at some point there is a reset of the rules, or we start playing a different game. That's how these things end up playing out.
Absolutely. I mean, look, most of us who live in modern, open, democratic societies accept that life should not simply be a free-for-all, right? We need a certain set of laws and a certain set of regulations that allow us to conduct our affairs in ways that hopefully minimize fraudulent behavior. Okay. And this is as true of money and banking and finance as with anything else. And the problem with this is that you want an unbiased referee to be enforcing those regulations, but we're in a situation now where the referee literally is reinterpreting the rules of the game as they go along to try to make the game proceed in the way they want the game to proceed. That is not the way robust natural economic systems work. And all it does is teaches the players, as you say, to dive or do whatever else to try and get away with not playing by the rules. And fraud becomes not just something that the referee is trying to prevent. It oddly enough becomes something that the referee is encouraging by that behavior. Hence why, arguably, in recent decades, but in particular going into 2008, and I would say also today, banks are over leveraged. Banks are taking risks they shouldn't be taking. And this is also true of many other economic actors. They're over leveraged, and they just believe that if you're big enough, too big to fail, and you get unlucky, well, you'll get bailed out and life goes on. I mean, that's one of the biggest lessons of 2008, and it perhaps helps to explain why there has been no meaningful general economic deleveraging since 2008. The referee, in a way, doesn't want it to happen because that might result in an almost immediate deflation and reset of the system. And the players want to milk it for all it's worth. And this is not the sort of football match, as it were, that would truly be worthy of spectators supporting and worthy of entertainment, other than just people complaining that the ref is doing a horrible job and the players really aren't playing to the best of their ability. They're spending more time trying to coax favors out of the referee.
I wonder if there's some sort of analogy between how much bankers and football players get paid. But let's move on from that. One of the arguments in the book is that a return to the gold standard would actually not be a surprise because, as you see it, there's actually a cycle in history where we do these experiments of fiat currencies and they feel good for a while, just, I don't know, like taking a drug would. And then there's the hangover and the consequence. And then at some point we do go back to gold. So, you can explain that cycle, because that's a strong argument that it wouldn't be a surprise to go back to gold because that's just what happens in these cycles.
Absolutely, absolutely. And so the core sort of economic historical thesis of my book is what I call the monetary cycle of history. And you've seen this time and again you see it in Greek history, Roman history, Byzantine history, European history, and of course today, world history. And the idea is this, is that the fact is empires throughout history, I mean, look, they obviously got something right. I mean, it's not, you can't rule a vast empire through brute military force alone. It's way too expensive. It causes way too much friction. You can't incentivize people to produce the food to create the excess that then even feeds the army. Okay, there needs to be some sort of balance, even in these old empires. And so that these successful empires, there's always a trade element, right? There's always a commercial element. And it's clearer in some empires than in others. But even in Hammurabi's code, I mean, you read Hammurabi's code and a huge amount of it is just the rules of commerce. And you can see here what's going on. Okay, that said, sometimes empires do get overextended. Sometimes they do start taxing too much. Sometimes they do rely too much on military force, which again is very expensive and causes lots of economic friction. And what do? Well, they start debasing their coinage. And they start resorting to various other economic shenanigans that, again, might buy time the way the post-2008 policy actions this time around have bought time, but they don't solve the fundamental problem. And sadly, what this means is that, the Athenian Empire collapses, the Roman Empire collapses, the Byzantine Empire collapses, because they get addicted to debasement as a way to try to paper over, and that's a good analogy here, paper over their fundamental economic problems. Well, guess what? Beginning in 1971, the United States was started to go down this road. During the 1960s, the United States was trying to afford not only the Cold War, which got very hot in Vietnam and a few other parts of the world. But also the United States at home was building the interstate highway system, the Great Society welfare programs were kicking off. And that cost a lot of money. And it basically just meant that the United States could no longer maintain gold convertibility for the dollar. And so President Nixon simply pulled the plug in August 1971. And so the US has been literally papering over its increasing debt imbalance problem that is chronically importing more from the world than it exports. That's been going on now for many decades. And I believe that 2008 is just the biggest of a series of crises which demonstrate that imbalance. And we're going to see another one at some point.
So the world needs a global reserve currency of some sort in order to conduct trade. You need to pay for goods internationally in some way. The local currency isn't what you want to be doing it in. And as a result of, I suppose, the post-World War II situation globally, the dollar was chosen at Bretton Woods, and then it sort of secretly lost this link to gold. But I want to read a particular section from the book, which made me laugh out loud, because it exposes just how ridiculous the idea that the US dollar is going to continue to work as a global reserve currency is. So I'll quote, "When one thinks of a reserve currency, one doesn't think of one that is exploding in supply, pays a zero rate of interest, is backed by a central bank that apparently will stop at nothing to prevent an over-leveraged economy from saving, is issued by a government running soaring budget deficits, used to finance prolonged wars and open-ended welfare policies, is the legal tender for an opaque and quite possibly insolvent or even fraudulent financial system, and has been steadily losing purchasing power for decades." In other words, the US dollar is not a good reserve currency, at least anymore. It's potentially, arguably, was one. And as you were mentioning, it was the 60s and the 70s that broke it, where we had the French president, de Gaulle, basically arguing that the world needs to go back to gold even back in the 60s, right?
Absolutely. And de Gaulle was advised by a very legendary economist, Jacques Rueff, who wrote some books criticizing even the Bretton Woods arrangements as being potentially unstable, and therefore proactively advising a return to gold already in the mid-1960s. France is an interesting one here, because even though, of course, France was allied with the other Western European powers and the United States against the clearly malevolent Soviet Union at the time, France nevertheless didn't fully trust their allies. And so France set about creating its own independent energy source, which was its nuclear network. And it relied on its power in Francophone Africa to get the uranium ore necessary to power that network. And then de Gaulle goes one step further and also develops an independent nuclear deterrent. And it's kind of an interesting historical curiosity. It was only after France had an extensive nuclear power network and had developed its own independent nuclear force that they directly challenged the United States monetary supremacy. Why? Well, I think that the fact was de Gaulle was afraid that the consequences of doing that would result in a complete rupture with NATO and would therefore threaten their national security and might even tear the nascent EU apart. And he wanted to be prepared for all of that before he directly challenged the United States.
But the point is that we might be close to that same inflection point for a whole bunch of other countries now. And you point out that it's very ironic that America sort of won the ideological battle of capitalism in the Cold War, and its US dollar was part of that. And yet now that it has won that, and a lot of other countries are becoming more capitalist, it might be just then that the US loses its US dollar reserve status.
Yes, exactly. This is the thing, right? The US might have won the Cold War, and thank God it did, if you ask me. But the fact is, alongside that, you had a number of previously very dysfunctional countries, including China, for example, that gradually economically liberalized. They realized that a full top-down command economy system just wasn't the way to maximize your national power. You had to move in, at least at least a little bit in the direction of a free market economy. And so you saw this opening up all around the world as it became clearer and clearer that the Soviet system just didn't work. And of course, after the Soviet Union blew up completely or imploded, whatever, choose your analogy there. It was ever more clear, and the progress that was being made accelerated a lot. And so the United States finds itself with much greater international economic competition. Many of these countries are extremely efficient at whatever it is they specialize in. Therefore, they export a hell of a lot more than they import, and they accumulate all of these dollar reserves. But once again, does that serve their interest? Does it serve your interest as a competitive exporter for your importing, sort of counterpart to just print the money for your exports every time they get into trouble? Is that a fair, longer-term economic bargain? Export-led growth is a classic economic model. The young United States itself went through that in the 18th and 19th centuries. But it can only take you so far. Beyond a certain point, it's no longer in your economic interest. I argue in my book that we've already passed that point. We've already passed the point where China and a handful of other very competitive, increasingly powerful exporting nations, they've actually probably realized already it's no longer in their economic interest. They just don't know how best to work their way out of it. But they do know it's no longer in their economic interest. And the solution to this unstable equilibrium, the game theoretic solution, is for the world to move back to international trade being settled in a currency that favors no one country over another, that cannot be printed by any one country to paper over its own problems. The only country that everyone can accept as a good benchmark, a good store of value to settle international trade that no one else can print and manipulate is gold. It is the only game theoretical monetary solution to the multipolar world we inhabit today.
If the listener's wondering why then do they stick with the US dollar as the current global reserve, given all of these problems, it's quite simply that if you don't, then you risk being locked out of the global trading system. So you've got to be ready to really make the move to a new system, even if it's backed by gold. And I think I read in the news recently that Russia's gold reserves are now larger than their US dollar reserves. That's the Russian central bank, I presume. And obviously China and many other countries have been accumulating lots and lots of gold over time. Before we get to what you just mentioned, this transition to a gold standard and whose incentives are telling you that that's going to happen, I wanted to explore something that you made clear to me more than anyone else has so far, and it's the role of inflation and stagflation in all of this. So I was struggling, like many other people, to explain why there has been no inflation as a result of the QE that we've had. And I think your argument in the book is that in order for inflation to really hit, especially severe inflation, you need to have government deficits and monetization. And I don't think we quite, until recently, managed to have both at the same time in quite the extent needed to really launch a proper inflationary period. And this is important to your book because it's usually an inflationary period that leads to a return to the gold standard.
Yes. I mean, if you look historically at periods of surging inflation, they, as you say, they tend to result from both chronic deficits and aggressive monetization. However, another important ingredient is on the supply side. That is, to what extent is the economy efficiently utilizing its capital stock? And one thing that we saw through the 2000s, going into and coming out of the financial crisis, was that emerging markets, as discussed a moment ago, emerging markets had developed their domestic capital stock for exports. And as a result, there was this very positive global supply shock. All of these goods coming from developing Asia, Latin America, and so on, flooding global markets and helping to hold down the price level. So you were able to have deficits and rapid money printing without that necessarily leading to inflation. However, coming out of 2008, what changes, and this is particularly true of QE and the effects of QE, is that by directly targeting asset prices, by directly hoovering up assets, central banks created what was primarily an asset price inflationary effect, as opposed to one going directly to consumer goods. And this is kind of where the role of austerity comes in. Around various parts of the euro area, certain governments decided that they had to at least try to make some effort to get their deficits under control, or they might blow up the euro. And of course, there was tremendous pressure from Germany and to a lesser extent, France, for some countries to do that. And then also, even in the United States, there was some pressure to try to keep the deficit under control. Germany ran outright surpluses for a few years. That's giving way now. It seems that the whole COVID pandemic gives everyone an excuse to completely ditch any semblance of austerity. And you're seeing stimulus absolutely everywhere. You're seeing it in the US, the UK, you're seeing it in Europe. And so the sort of barriers to these deficits, more directly targeting aggressive consumer support, now do combine with the continuing monetization and also kind of I would say, the end of this industrialization in emerging markets. It's gone a long way now, and emerging market wages are a hell of a lot higher than they used to be. And so you're not going to just get this ever-increasing flood of cheap goods from emerging markets. There's been a certain catch-up that's taken place between emerging markets and the developed world over the last 20 years. So now you finally have all the pieces in place. Now we're really going to start to see inflation take off. But the problem is this: the capital stock has now been misallocated. We've had really bad monetary signals now for a number of years. It's hard to see exactly where these misallocations are, but we know they're out there. We know that there has been overinvestment in some areas, underinvestment in other areas. That's going to have to work itself off. And while that's working itself off, the potential growth rate of the economy is going to be structurally weak. So you've got all this inflation pressure coming through, but you've got these structural issues that are going to have to be worked out. And that's where inflation meets stagnation and you get stagflation. That's where we're going over the coming years.
That's what we might call the real economy, what people are experiencing every day. Meanwhile, there's this stock market boom that's happening, and that's very tightly related to the whole story as well. And you quote one of my heroes extensively, Kurt Rischebecker, who's a German, I think, economist, who predicted the financial crisis of 2008 fairly accurately, I believe. And there's a particular quote from him that I really loved, and it's when he says that he's explaining how inflation causes asset prices, so share prices, to rise. And it doesn't look like the inflation that we fear. It doesn't look like consumer price inflation. And so as a result of the inflation going into the stock market, he says that everybody feels comfortable with this misjudgment. So I love the idea that when these booms in the stock market, which are financed by QE and funny business on the monetary side, when they're playing out, everybody loves this story. You know, it's the roaring 20s, the tech bubble's back. This is just fantastic. And historically, that's just always what's happened. The Mississippi bubble was very similar, and you go into that in detail. But these bubbles burst, and that's when I suppose the stagnation overtakes the inflation.
Absolutely. Absolutely. And again, you can't time these things precisely. If you could time them precisely, in a way, they would never form in the first place. If the world's completely irrational and everyone knows what's going to happen next, you're never going to have a bubble. It is human nature to sometimes get very excited about something, be it a new technology, be it, whatever it might be. And people will throw a lot of money at it, hoping to make a lot of money. And that's just human nature. But the problem is this: when the money itself is bad, when the money itself is unstable, it allows these bubbles to grow to sizes that when they pop, they don't just pop a given business or a given industry, they pop an entire economy and financial system. And that's where we are today. That's the lesson of 2008. The whole system has become too big to fail, as it were. And the authorities, therefore, are willing to keep the party going. And of course, the participants making money from this, and the most highly leveraged participants in the whole system, are the banks themselves. These are the people with the least incentive to try and sort it out. And so it's only around the periphery that people begin to act in their own marginal ways to start hedging their bets, to start protecting themselves. And that's why we see gold trending higher. That's why we see other real assets trending higher. It's interesting to note that there's been a huge surge in food price inflation over the past year, and that's impacting farmland prices, predictably, understandably. Things are kicking off. Again, we're starting to see now the calculus shift as people see what's happening more clearly and move to protect themselves. But that just becomes a self-fulfilling prophecy. You've built up all these bubbles. You've resulted in all these misallocations from the monetary and fiscal actions. And so now, when people simply move to protect themselves, that pushes up prices for real goods because you hide in real goods. You protect yourself in real goods. That becomes a self-fulfilling stagnation prophecy as people hoard real goods out of circulation, be it gold, be it farmland, be it anything else. That's a negative supply shock, and that results in the stagflationary outcome.
Before we get to the geopolitics, which is how we move back to a gold standard, I have a tricky question for you, which just occurred to me as I was reading the book. If we hadn't had Paul Volcker, would we be back on a gold standard now?
I think probably, again, you're giving Volcker a lot of credit, but to be fair, he deserves a lot of credit. Let's talk about the whole Volcker episode to generalize it a little bit. I mean, he led the charge to try and do what he did to restore confidence in the dollar, absolutely, but he wasn't alone. However, it was a close run thing. And keep in mind that when President Nixon closed the gold window in August 1971, it was viewed as a temporary arrangement to try to renegotiate Bretton Woods, and in particular, to renegotiate a one-off devaluation of the dollar vis-a-vis the US's trading partners that would restore some balance of trade, because the US had been chronically importing more than it exported. And the idea was, a one-off devaluation of the dollar fixes that. Well, they tried to do that. But by 1973, they sort of gave up. They negotiated for 2 years, and they just couldn't agree how to make it work. And so the world just moves to this free-floating currency system. Well, guess what? In a free-floating currency system where everybody can print as much as they theoretically want to, everybody did. And oil prices went through the roof as a result, not just in dollars, but in almost all major currencies. And by the late 1970s, this was out of control. And the United States was arguably in the lead because they had enjoyed the reserve status prior, and therefore the dollar was the biggest loser as everyone just printed and bought gold, bought whatever. And so Volcker comes in, and it's interesting. When he speaks to his colleagues at the Federal Reserve, he talks as much about the dollar's external value as about anything happening domestically. I mean, imagine that. Imagine how important the dollar had become. And you had multiple prominent economists at the time, and this includes Alan Greenspan, writing op-eds in the Wall Street Journal and the New York Times, basically saying, look, the only way out of this is to go back to gold. And when President Reagan was elected, he appointed a gold commission to study how and whether the United States should return to gold. And that commission voted by a narrow majority to try and keep the existing fiat dollar system intact, but they only reached that conclusion after Volcker had brought inflation down into the low single digits again, and it appeared the crisis had passed. I mean, the US came this close to going back to gold, in my opinion, and it was Volcker's success that kind of made it a moot issue by 1982.
It's ironic for people who believe in sort of sound money, who usually like Paul Volcker, to think that his tight monetary policy, his very brave tight monetary policy, ended up preventing the return to the gold standard. But let's Indeed. Go to the geopolitics. And I like the way you characterize going back to a gold standard or having gold as a reserve asset as what happens when the international order breaks down or when there's a multipolar world. Can you explain what you mean by that and just how true it is historically?
Well, as I mentioned, the gold solves for this monetary equilibrium for a multipolar world. That is, obviously, if there's one country that's the powerful, dominant country and everyone else is weak, well, that country can choose to do whatever the hell it wants in monetary affairs. It can print its own currency all day long for imports, and nobody ever has to work ever again. But in a multipolar world, you just can't do that. And what you notice historically is that big debasements really only happen in the big, powerful empires because they are at least temporarily in a position to debase their coinage and force everyone else to accept it. I mean, this is what the Romans did. And the Romans' trading partners didn't exactly like that very much, right? And so, oddly enough, the barbarians coming in from the north, they had a more solid coinage that they would use. And the Romans on the periphery of the empire, they preferred to use the undebased coinage of the barbarians. But the Romans said with their legal tender laws, no, you can't do that. But of course, the barbarians eventually win that monetary battle, as it were. And it's an interesting curiosity that the Western Roman Empire continued on down the debasement route until they completely collapsed, whereas the Eastern Roman Empire, headquartered at Byzantium, kept their coinage relatively stable, and indeed all the way up until they finally succumbed to the Turks in the 15th century. You know, they kept going a long time, in large part because they kept their coinage stable. So there's a real lesson there that in a multipolar world, you always see, and I can't stress this point enough, you always see stable international monetary systems based on sound coinage, which is usually some combination of gold and silver. And it's only when you see unipolar systems, imperial systems, that you see coinage that gets debased. Today, the fiat dollar is just really yet another example of this monetary cycle of history. But when the things do blow up, people go back to sound money. They go back to non-debased coinage, and healthy, sustainable economic growth can once again get going, sometimes with very spectacularly good results.
I think that highlights why we spent time on the inflation argument and the weaknesses of having the US dollar as your global reserve currency, and the problems that creates, because then it creates the need to go back to gold. And you make the point in the book that there's no viable alternative to gold because there's no emerging unipolar world that is going to replace America. And you comment on the euro, which we won't go into too much. One of the possible transitions to all of this, which I found particularly likely and interesting, especially because the historical references are relevant, is the idea of the oil exporting countries going from what was the petrodollar standard to what is the petrogold standard. Now, I've got to mention that I believe the Venezuelan government cryptocurrency is called petrogold. So we're not talking about that. And unfortunately, Maduro's stolen my innovative new name. But in the sense that the petroleum exporting nations could turn to gold instead of the US dollar for payment, could we be seeing a gold standard emerging?
Well, certainly it's possible. And again, some people speculated this is what was happening in the late 1970s and early 1980s. That is, the whole formation of OPEC also resulted in those countries, those members, accumulating lots of gold, right? And there was a movie made about it called Rollover, starring Chris Christopherson and Jane Fonda, which was kind of a fictional take on these oil exporting countries accumulating gold and potentially crashing the global financial system, which was dollar based, as a result. And so people have been thinking about this for some time. But now, I mean, fast forward to today, and yes, you have occasional examples of oil producing countries expressing disapproval. Of course, you know, they tend to be ones that don't have a good relationship with the United States in the first place. But the fact is that some countries, and increasingly powerful ones such as China, they're not really too bothered by that, right? They're more than happy to source their oil from countries that might have issues with the United States. The same is true of India to some extent. The same is theoretically true of Japan, but they have to be very careful because they feel they're very dependent on the US military for protection. And indeed, you could argue that's true of the big OPEC gorillas, Saudi Arabia, to some extent. They also feel that they're dependent on the US for protection. But Russia has also emerged as a huge oil producer, but one also with a huge military. And so you've got lots of moving pieces here. And look, I don't believe that I or anyone else for that matter is capable about predicting where this goes in its specifics. That's why I like turning to Nash equilibrium game theory. The fact is, all of the actors I just mentioned, they each have their own unique set of incentives. But those incentives are increasingly moving in the direction of preferring a sound international money with which to settle international trade rather than an unsound money, which is not only against their own interests, but disproportionately favors the United States, which is no longer anywhere near as powerful as it was a few decades ago. Indeed, by some estimates, purchasing power parity estimates, the US economy is now less than 20% of the global economy. It just doesn't make logical economic sense for the United States to still be able to act as an international monetary hegemon. And game theory instructs that this unstable equilibrium is going to shift to gold, again, as the only truly neutral, unmanipulable store of value international currency, which has been proven throughout history to be the way to deleverage, to rebalance, and restore healthy economic growth when you end up in situations in any way similar to that we have today.
So far, we've spoken about how this plays out at the geopolitical and between nations level, but your book also goes into how this might happen from the bottom up, as we like to say, instead of from the top down. So instead of governments controlling the process, we might have individuals and companies controlling the process. So the analogy you use in the book is, Airbnb's effect on the hotel business, Uber's effect on the taxi business. Well, we might see something similar from fintech and fintechs, so financial technologies, effect on money, and that could be sort of the back door to a gold standard.
Yes, I think this is something that is increasingly appreciated. I think previously, that is prior to Bitcoin, I don't think people were very open-minded about the idea that bottom up, person by person, household by household, and so on, that people could simply change the way they think about money and begin to act differently as a result. And through their actions en masse, create kind of a bottom-up monetary revolution. The fact is, I mean, again, let's take the United States because it is the current global monetary hegemon, de facto hegemon. If Americans just decided, you know what, the dollar may be the legal tender, but we really don't think it's a store of value anymore. So we're just going to choose to hold some, mix of Bitcoin or other cryptocurrencies, gold and other precious metals. We're going to snap up more real assets, property, farmland, infrastructure, whatever it is, and we're just not going to buy treasuries anymore. I mean, that kind of blows it all up right then and there. Now, of course, it's not going to be that easy, and the US government has ways of practically forcing banks, insurance companies, pension funds, and to a lesser extent, individuals to hold US debt. There are ways that governments have to practically force their domestic saver base to hold their government debt to finance their deficits. But it's difficult and it becomes untenable. And so if just your rank and file US saver were to take things into their own hands, they would eventually force the issue. They would eventually force the US and by extension the global economy back onto a gold standard. I think that scenario, while unlikely, is certainly more plausible today than it was before the financial crisis and before Bitcoin helped to educate a new generation about what money fundamentally is or what it should be when what we have today clearly isn't functioning as a true store of value, stable money to underpin healthy economic growth.
Your book finishes on the topic of what the world looks like under a gold standard, and you give the positives and some of the negatives as well. So it's a fairly balanced view. You also give the investment implications, including the price of gold, but also, for example, how stocks would be re-rated in a low inflation, no bailout world, and governments would have to be more responsible, where the gold price might go. But I think I want to move to some challenges before we run out of time. So the parts where I disagree with you or haven't made up my mind yet, and I think some of the challenges that people of the gold standard or critical of the gold standard might point out. And the first one is that I'm a big fan of gold and gold-backed money, but I'm also a big fan of floating exchange rates. And I have trouble, obviously, combining the two. So solve the problem for me.
Okay. I mean, the idea behind floating exchange rates, and this is where Milton Friedman, for example, is such a monumental figure when it comes to international economic theory, is that if you allow exchange rates to fluctuate, then to the extent one country imports more than it exports and vice versa, well, the exchange rates should move over time to eventually correct that imbalance. So, one throughout, a given economic cycle, one country might be importing more, one exporting more, but in the next cycle, it switches back the other way, and exchange rates facilitate those adjustments. I don't disagree with any of that. I don't. And if you lived in a world where governments in general were constrained in their ability to run deficits and run up huge debts, I actually think that system could work quite well. However, we live in a world today where countries, open democratic societies, have chosen to finance their welfare states and the growth thereof with debt. And so you have this intergenerational imbalance now, where you've built up these huge welfare states that have run up huge debts, and the next generation has to service those debts. Now, in some countries, this has become quite extreme. In the United Kingdom, for example, I believe just shy of 20% of annual tax revenue goes to servicing the debt that's been run up through the decades to build the modern UK welfare state. So basically, what the older generation in the UK has done is leave the younger generation with this bill, which is roughly 1 in 5 pounds, right, that simply goes to service what was consumed prior. Now, I think that's unfair. I mean, I'm a parent. I have children. Do I really want to, sail off into the sunset and leave my children servicing the cost of building the sailboat? No, I think that's simply morally wrong. And so to go back to this floating exchange rate question, to me, the problem isn't that in theory that would resolve the international imbalances. The problem is it allows every government to debase, in theory, in equal measure, to finance a welfare state, which is great today, but leaves the younger generation holding the bag tomorrow. Gold will stop that. It will make intergenerational finance much more difficult because you'll have to service debt out of current rather than future taxation. That, to me, is one of the most benign characteristics of a gold standard.
I think a lot of the viewers and listeners will be thinking that this sounds quite good to return to a gold standard, and you make lots of good arguments. But if they're reading the news, it seems to be that things are going the other way, at least in the UK and the US and most of Europe, that we're heading towards the polar opposite of the gold standard, which is MMT, modern monetary theory, basically printing money to finance deficits. So what would you say to those people that are, listening and agreeing, but when they close this window and they look at the news, they see the opposite happening?
I think that MMT may be tried. De facto MMT, as I call it, I think has already been kind of the case since 2008. They just choose not to call it that. But there's no fundamental difference. I mean, the core point of MMT is that governments should just finance deficits by printing money. Because basically, what is that? That's zero interest rate debt. Currency, paper currency, or paper, if you just digitize it, right, you can do it that way and just credit people's bank accounts. But if the interest rate is zero, which it kind of has been for the most part since 2008, well, then there's no fundamental difference. MMT just takes what is already happening de facto and makes it de jure. It makes it, the actual letter of the law and monetary policy. Now, it's possible that we will continue down this road a bit farther. It's possible that MMT will become official policy. But it's difficult for me to see how that can possibly be sustainable for a country like the United States, especially, which issues the reserves and imports far more than it exports. I mean, if the United States basically admits to the world, hey, look, we're done paying interest on our debt. We're just not going to do it anymore. And if you're going to own it, well, guess what? You're not going to earn any interest. Well, one step farther from that is the following. Well, we're not even going to hold it at zero anymore because our debt burden is so large. We're going to actually move towards a negative interest rate regime. So if you want to hold our reserves, which of course is how we finance our imports of your goods, if you're going to hold our reserves in exchange, we're going to tax you. So not only are we going to pay you nothing, we're going to tax you to export to us. I mean, that is just so nonsensical. There's no way that China and others are going to accept that sort of regime. So MMT is sailing so close to the wind. At that point, I think the boat is simply going to tip over, and negative interest rates will simply never work. And so the US is going to have to, at some point, rationalize this either unilaterally on its own and restructure its economy in a way that allows it to begin to export roughly as much as it imports, or the rest of the world is going to eventually go through this Nash equilibrium reset process of replacing the dollar reserve standard with gold to settle these huge imbalances that have been run up over the decades.
I think that illustration of just how absurd the current system is a great way to finish, and it sums up really the desperate need to go back to gold and why it's so likely. So John Butler, you've written The Golden Revolution Revisited, How to Prepare for the Remonetization of Gold. Thanks very much for joining us.